Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning and welcome to the show. It's, of course, the second best day of the week, and it's even better today because Michael Lebowitz is joining us live in studio today. Actually got him out of his basement bunker. His mom let him out, finally. So, joining us in studio today, we'll talk a little bit about Kevin Hassett, talk about the Fed meeting next week, what to expect, what that all means for the markets. Of course, we'll get on all that in a few minutes. Economic news out over the last day in particular is so we had the ISM manufacturing report out earlier this week. That was in contractionary territory, continues to be weak on that side. However, services actually came in just a smidge better than expected, but not far off of contractionary territory. In fact, ISM services has been kind of hugging that 50 line now for the last really kind of year and a half, 2 years. It's just been, kind of bouncing off that 50 line. We remain in expansion, but not really showing any type of acceleration in the economy, which historically speaking is very unusual. Generally with the ISM services, it's either rising fairly sharply and showing the expansion in the economy, or it's contracting and showing contraction in the economy or recession. It's very unusual for it to kind of just baseline and just kind of float sideways. So this has kind of been the abnormality of the markets over the last really 2-3 years, as all that liquidity that we had from the post-pandemic bailouts, all that type of thing, has slowly been working its way out of the system. So we're just continuing to kind of grind back to this normality of about 2% growth, ultimately 2% inflation, and that's just kind of been the trend. But again, as this data continues to work or actually I should say, as the monetary impulse continues to work its way through the system, we're likely going to continue to see this kind of sloppy economic data that just doesn't show a lot of real robustness to it, but it's not recessionary either. However, there's certainly some signs of economic weakness. We saw the ADP report out yesterday, was negative 31,000 jobs, something like that, which certainly points to potentially a weaker Bureau of Labor Statistics non-farm payrolls report. That has continued to kind of trend weaker as well. While the reports can deviate from each other from one month to the next, the trend of the data between both the ADP and the non-farm payrolls report tend to be fairly close. So the trend has clearly been into weakening employment. And we're also seeing that show up in the ratio of the leading economic indicators to the current economic indicators, which is also suggesting that the economy remains actually just fairly weak, and why the Fed may be more inclined to cut rates here. Even though markets are booming and everything is doing fine, at least on the surface, underneath that, there is clear weakness in the economy. And again, if the worry is about a recession in 2026, 2027, that's why the Fed is likely to be cutting rates some more, at least as we get into next year. But that's something we'll talk about this morning with Michael Lebowitz when we get started here in a few minutes. Outside of that, earnings are mostly done across the board. The whole earnings season came in better than expected. Not surprising, as we came into earnings season kind of under expecting the returns because of the tariffs that we had implemented back in April. Wall Street kind of ratcheted down earnings estimates, kind of got below the bar, so to speak. So that really gave corporations the ability to beat and raise guidance. So we've seen a very sharp increase in the number of companies beating estimates. Again, millennial earnings season, everybody gets a trophy. But also we've seen a very sharp increase of companies raising their guidance for next year rather than lowering guidance. So overall, the earnings season was very good. And certainly doesn't suggest there's any major risk to the markets, right now anyway. Again, that doesn't mean that can't change next quarter, next month, whatever. But at least right now, the backdrop from earnings season continues to kind of really foster this kind of bullish support for the markets. Of course, we also have buybacks. And of course, we also are going to have performance chasing here over the next couple of weeks as we get closer to the end of the year. But that brings us what you need to know before the bell this morning. And yesterday, the markets did rally a little bit again. Had a nice little rally day yesterday. Sold off right at the end of the day, but nothing major. But again, just from a technical perspective, the markets are just doing kind of what markets do. Nothing really overly exciting here. We've just been, despite all of the concerns earlier that, we were, this big correction back in November and everybody was kind of freaking out. It's like, oh, it's the end of the AI trade. Got to get out of the markets. It's all going to crash. This was that correction right there, which was a total of about 5% from peak to trough. Not really anything major, but really just has turned out to be just a consolidation of the market following this very nice kind of rally we had ever since the April lows. So again, not surprising here that markets are just kind of consolidating gains a bit. It's not as exciting. That rally that we had from, May, June, July, August, September, that was really exciting because markets just kind of went up every day. So nobody likes when you don't go anywhere. We're kind of just sitting in place. But that working off that consolidation worked off some of that overbought condition, that correction that we had back there. Kind of in November, worked off that previous overbought condition. So we've seen an improvement in relative strength that's been helping support this rally in the markets as of late. Markets are coming up to test right now. We're testing resistance at these previous highs. So, right around this level, we may see the market kind of struggle a bit. But if we can get a breakout above these highs that we had back going into November and this high level that we have that we're challenging right now as of yesterday, that's going to give the market some more room to run into year end. So right now the setup still looks like going into year end that we're going to get kind of a rally. Now, having said that, the kind of the traditional Santa Claus rally setup is certainly kind of in place at the moment. This kind of action that we're seeing momentarily, again, we're going through mutual fund distributions right now, would not be surprising that over the next week to week and a half, heading into kind of the Christmas holidays, that we see this market maybe pull back towards the 50-day moving average, which is sitting right there with the 20-day moving average. So a bit of a pullback here to that support level would not be surprising over the next few days, next week, week after. And then that sets you up kind of for the year-end rally and to close out the year. That's going to be the window dressing. That's going to be performance chasing. People, all the professional managers trying to get the right positions on their books for the end of the year. We're on a buy signal, which is also supportive of the markets right now, and that's coming up from a decently low level. So again, there's some impetus here for the markets to kind of work its way higher. But as we've talked about over the last couple of weeks, be careful over this next 2 weeks. We could see some volatility, see this market sell off again. If we see a bit of a pullback, you're going to see a lot of headlines like, well, Santa's not going to come to town this year or whatever. You'll see a lot of those headlines. Historically speaking, we did have a negative December last year. It is very, very rare for Decembers to be negative 2 Decembers in a row. It is possible, it has happened like once or twice before, but it's a very rare outcome that you have 2 negative Decembers in a row. Doesn't mean it can't happen, but the odds are the way we're kind of setting up for the year end. After this recent correction that we had, that kind of refreshed the markets, that gave us a good buying opportunity. And again, where the market's kind of setting up right now, the odds are we're likely going to end higher as we get into the end of the year. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Lebowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Like I said, Michael Lebowitz joining us in studio.
Out of my bunker.
Out of your bunker. It's an amazing thing. Be sure, and Michael Lebowitz, by the way, will be at the Economic Summit coming up in January. So again, tickets are selling a lot more quickly this year than they have previous years. So again, if you haven't got your tickets yet, be sure and swing by the website, realinvestmentadvice.com. Get your tickets. Mike will be there. We're going to have a mixer the night before. So if you want to come hang out with Mike for a bit, talk to him, you can buy a ticket for that as well. So again, we're going to have lots of really good events. The whole presentation lineup is going to be really good this year. So again, look forward to seeing there. Like to meet all of you. So again, get by the website, realinvestmentadvice.com, get your tickets, and we'll see you there. It's January 17th.
We should be paying them to come and talk to us.
Probably. Probably true. But don't put that out there.
I won't. Keep that on the down low, everyone.
Exactly. So, all right. So a couple of things, Mike. I saw an interesting kind of poll out this morning that now have 80% probability that Kevin Hassett will be the next Fed chair.
Correct.
And markets don't like that. Or do they like that?
I think they're trying to figure out what they like. The thing with Kevin Hassett is he's pro-growth. He's a supply-side economist, which means he's going to push for probably lower rates. That's why Trump wants them.
Right.
And we know that. That's kind of a known commodity. But he'll push for more deregulation of the banking sector, so lower capital. That's pro-growth. So what I think the market's grappling with is right now we kind of have this tug of war between do you support the labor market and are you worried about inflation? And the Fed's kind of towing that line. They're not being too aggressive cutting rates because of their concern about inflation. The risk is that we get someone in charge that becomes more pro-growth, less worried about inflation. They just assume inflation is going to come down. Then the market gets worried that inflation is not being cared for properly. So, Powell's not leaving till May. Hassett, first of all, hasn't even been nominated. He hasn't been voted in. There's still a long road ahead of us. And look, by the time we get to May, inflation may not be a concern, and Hassett may be the right person, or inflation may start going back up again, and Hassett changes his tune, or it's just not Hassett, it's someone else.
Right.
So
look, that is a good point. Is that that's a long road between now and next May.
Right.
So there's a lot of stuff that can happen.
It's not hard for him to screw up and say something that Trump doesn't like.
Exactly. So so again, there's a lot of things that can happen between now and then. But it is interesting. I mean, there's Kevin Hassett seems to be more of a polarizing character. In other words, there's people that like him and then there's people that hate him. There's not a lot of people in the middle.
Right. And we'll just see how he can get through. Assuming he gets through Congress, do his views change? And he's only one member. He's only one voting member. He has the most sway, but he's one member of 12 or so that vote. So it's, even if you're very scared that Hassett's coming in and he's going to push rates a lot lower and not care about inflation, that's 1/12 of the vote. So, it's, I think it's something the market's thinking about, but it's not. Maybe some of the recent weakness in bonds, which hasn't been all that much, but some call it consternation in bonds.
Yeah, I say like bond yields haven't gone anywhere.
No,
for like 6 months.
They stopped drifting lower. It was kind of like what you just showed with the stock market. It's consolidating.
Yeah. So, but that kind of brings us up to kind of your article that you wrote on Wednesday too, which was talking about the end of kind of this groupthink that's been going on with the Fed, and now you're starting to get a little bit more dispersion in outlooks when we get the dot plots, right? Especially with Steve Moran now on as a voting member, we're starting to get more of a dispersion in the dot plot. The dot plots used to be very, very like just a cluster of dots. They were all very, very close. We're starting to see more of a dispersion in those dots, and that was kind of the point of your article, is like questioning this idea is that maybe they're just this kind of groupthink is finally starting to end.
Well, it was interesting. A few weeks ago when I got the idea for the article, the Fed voting members were being very outspoken about, I'm going to vote for, they're going to vote for a cut, they're not going to vote for a cut. Normally they just kind of weigh the pros and cons, but they don't really tell you what they're going to do. This time, a lot of them were kind of telling you how they were going to vote, and the vote was more or less split up the middle. Some, about half voting yes, half voting no, and a few kind of didn't know how they'd vote. And if you kind of think about it, if they were taking a vote that day, there could have been 4, 5, 6 dissenting votes. Typically, I ran the numbers back to, I think it's 1936, and on average, there's half of a dissenting vote at every meeting. There were 2 at the last meeting. One wanted to go 50, and one wanted to not cut rates. That was a lot at 2. So if we're starting to talk about 4, 5, 6 people at some of these meetings dissenting, it's kind of telling me that the chairman is losing the ability to form a consensus opinion. And I think that's a good thing. The Fed has not, been great with monetary policy. So I think what it would be really nice to hear from the Fed is we're cutting rates, but 4 of the people said they didn't want to cut rates because of this, that, and the other. It's not a majority, but it is enough to cut rates. We'll cut rates. I think having those different views and allowing them to dissent, allowing them to speak their minds, just gives investors, gives the world, consumers, business leaders, a better take on what's really going on at the Fed, as opposed to this, we're all on the same exact page. Because it's monetary policy is to some degree like predicting the weather. And you just don't know what it's going to be the next 3 days.
It's very close to predicting the weather, and most weathermen are wrong after 3 days.
Right.
So that's the problem. But it also kind of is an interesting thing, because if let's just say, for instance, we have a vote that comes out, and let's just say it's 6-4, whatever, right? Mm-hmm. So it's close. There's enough of a majority to cut rates or raise rates, whatever it is, but it's close, right? That could potentially weigh negatively on the economy, because if the economy, to your point, if consumers and business leaders and those type of things are going, okay, hey, you're great, you cut rates, that's good for my business, right? I can go refinance, I can go build a rental property, whatever, because I've got lower cap rates, et cetera, whatever. But that vote is very close, maybe, because maybe at the next meeting they talk about hiking rates. So maybe I don't go I don't make capital expenditures, maybe I don't go make purchases, because of this non-consensus that's going on. So, is it possible that could also backfire by them not being more cohesive?
Well, let me ask you a question. Let's say that's the case, and but they all vote the same way. But there's half of them are thinking we really shouldn't be cutting rates, and maybe we should be raising rates. If you were going to spend money, wouldn't you rather find out at that meeting than 3 weeks later when they start speaking? So, I guess all I'm saying is just be honest with your views. Just let us know. Now the risk to this is it becomes a little bit like the Supreme Court, where it's very, very politically driven, where you have your hawks and your doves and your Democrats and Republicans, or however they're going to split up. It can just split up by economic theory, politics, a whole host of things. And there's, or Congress, where it's always a 50-50 vote. Right. And it's not based on the economy. So it can go a number of ways, but I just think honesty and expressing the views is probably best for economists, for investors, for consumers, for business leaders.
How about this for an idea, Mike? How about we go back to the way it was before 2000, and they just shut the hell up?
That would be nice.
And we don't hear from them, and we don't know who they are, and they're just kind of pulling some levers in the background with the banks, and they just stay out of the markets and let the markets. What about that idea?
So 2 more things.
All right.
Hassett does want more open communication, so that foils that idea.
I think we need less.
But he wants formulas, things like the Taylor rule, or other mathematical formulas.
And look how well those have worked. Rates. Yeah, let's look at those models they've used and look how well those have worked over the last 20 years.
Exactly. So, I unfortunately, I do hope that they do express their views, and that there are opposing opinions, and they're allowed to vote the way they really want to vote. They don't have to feel like they have to form a consensus. I think that's a positive. But at the end of the day, I'm not sure how much will really change with the Fed in their ability to do the right things.
Yeah, I'm going with the Dave Chappelle theory. Hey, why don't you shut the fuck up?
I second that.
Yeah, but anyway, but it is interesting. Just from the standpoint that, this is what the markets have now gravitated to. Again, as I was saying, pre-2000, really, you go back to the 1990s, when you and I were first getting started, You go down the street and ask somebody who the Fed chairman is, I have no idea.
Right.
I mean, they were just this kind of anomalous people that were out there somewhere. We knew there was a Federal Reserve, but knew nothing about them or what they were doing. Paul Volcker back in the 70s was probably the most notable guy, and most people didn't even know who he was. Right. Except now in history, we look back and because it was Volcker and Reagan, so we know what was going on back then. But after Alan Greenspan and really the late 90s and really early 2000s, all of a sudden the Federal Reserve became this big prominent figure, and now the markets are just attached to them. And it's not just the professional market traders, right? It's now every retail investor is looking at the Fed. It's like, oh, they're going to cut rates, or they're not going to cut rates. Let's look at what happens when they cut rates to the markets. Markets go up because of more liquidity, and so we've got this whole market now. And again, this has been the case over the last 3-4 years, is that we're going through a correction in 2022 as a good example. Markets are declining. We're working through a reversal process, which is great, good, healthy thing for the markets, but we're getting these boomer rallies on expectation the Fed's going to stop. Oh, is the Fed going to stop cutting rates this meeting, right? Oh, no, they're not. Okay, so we sell off again. Next meeting, are they going to cut rates? So we run it up into the meeting. But every meeting now has been a driver for the markets.
Well, I mean, it's all about liquidity.
Yeah.
And the Fed has taken, this was my article from a week or two ago. And by the way, I'm done with the Fed. I think this is 3 articles in a row. I will move on to something else next week, I promise.
Good luck finding a topic.
Well, that is the problem, because it all starts with liquidity. And since 2008, the Fed has kind of taken over that liquidity doling out process. Now, maybe that will change with capital requirements, with some other things, but that's the problem, and that's why we have to spend so much time on the Fed. Do you remember on Thursday afternoons they would release the money supply?
Yeah.
That would be the big announcement. And that was the signal as to kind of what the Fed was doing. But at the time, it was banks and mutual funds and money market funds. They were the ones supplying liquidity to the markets, and you never knew how much they were supplying or what their views were. One big bank may have been supplying a lot, the other one may have been pulling back. So there was not this dependency on one entity to tell you how much liquidity would be coming into the market. Now we have, it's not just you get a QE number, a QT number, their balance sheet number every day. You can see what reserves are. It's like we have these real-time measures of liquidity, whereas we were flying blind.
Yeah. Well, and again, that kind of brings us to kind of where we are right now, which is, so the Fed has now ended QT, and we're going to the meeting next week. So we're, I think there's an 80% odds right now we get a rate cut next week. They've ended QT, and just over the last week or so, they've injected a big chunk of money into the repo markets as well. So, again, we're starting to see that liquidity concern in the markets. What's that telling us?
Yeah, so liquidity is strained, and we can look at reserves. There's quite a few charts we could see. We could see how some of these overnight money market rates are trading versus each other. That there are trades that really shouldn't be happening. There's free money to be made by lending to some entities, but they're not lending. So, the markets are telling you there's some degree of stress. And honestly, Lance, I think Bitcoin is one of those markets. It's very speculative, and I think it's kind of liquidity stress that's holding it back. If you chart the change in Bitcoin and the change in reserves or the change in a monetary base, they have a very high correlation. So it might just be that Bitcoin is just a surrogate for liquidity.
Right.
Shocker.
Well, again, it's, whenever you have assets in general, right, they tend to start to migrate. And it depends on who's trading them, right? If you're getting a lot of institutional trading, those type of things, hedge funds, et cetera, then, yeah, they're going to start kind of correlating back to liquidity settlements. So,
and I think the more speculative, the more it's tied to liquidity.
Yeah.
So, Procter & Gamble, much less tied to liquidity than NVIDIA.
Right.
And NVIDIA less so than Bitcoin.
Right.
And you can go up and down the line. Recently, I don't think gold, silver have been extremely tied to liquidity, which is a little interesting. I think they were for a while, but that correlation is broken off. So, I think what this really leads to is possibly a prolonged period of consternation, consolidation, where the market may be trending higher, maybe a little lower, but not really jumping or falling unless liquidity really becomes problematic. But then it's a question of when does the Fed come in? When do they really start up QE? I actually saw one of the Fed members, I forgot the word, but they were talking about reserve management. It was something reserve management.
Mm-hmm.
It's called QE. Right. They're going to try to disguise it.
It's just a different word for the same thing.
Right. Well, if you remember in 2019, they started QE, but they were doing it on Treasury bills, and they were saying, "Oh, it's not QE."
Right. It's not QE.
It doesn't matter. If you go to the candy store and buy candy, whether it's for 50 cents or $5 or how big or how small it is, you're buying candy,
right.
And that's QE.
Right. And again, we'll see how this will. Again, I'm anxious to see this next meeting now that they've stopped QT, because again, I'm just wondering how long it's going to be now before they start talking about some form of QE.
And what's interesting is, this all kind of started post 2008. They put more and more capital restraints on the banks, and basically, in doing so, the Fed had to become the leader of doling out liquidity. So, over time, they've had these mini crises, and they've had these issues, and they've built these other programs around it that are caps and floors and like safeguards, bumpers. And, so I think the Fed's like, well, we have all these programs. So, yeah, there's a little stress, but we have all these things working. I think we're good. Let's see how they work. But inevitably, they probably at some point do fail. It's a matter of time. And the question is, how much do they trust these programs, or are they going to want to just start insuring themselves with just a little QE or some other program that puts liquidity back in the market? Because right now it seems that even though they're stopping QT, reserves are still going to fall on the margin. Maybe not as much as they would have,
right,
but they're still going to fall. So that's just slowly putting more stress on the highly speculative ends of the market. And, one of the problems, Lance, is that the Magnificent Seven are kind of controlling the market right now.
Right.
And a lot of them are highly speculative. So this isn't like your days of Exxon and Procter & Gamble running the S&P. So,
yeah. Well, it was just like yesterday. I did an interview on Fox Business yesterday afternoon, and they asked me about Oklo, and because I said, it's probably it's down 50% from its peak. It's had a huge correction,
right?
And I said it's probably good for a trade into year end. Wouldn't be surprising. It's decently oversold. If the market rallies in the year end, it's probably going to get a nice little bump into year end. And she had the host asked me, he's like, well, why just a short-term trade? I said, because they have no sales. This is it's a great thesis that Oklo is going to build all these nuclear power plants. May very well be the case, but right now they have literally no revenue. They have all expenses and no revenue. So at some point they've actually got to start generating revenue, and when they actually start generating revenue, it's a different story. But it can be a very long time between where we are today and them ultimately getting a nuclear reactor up and running and actually making revenue.
Well, more problematic. It's a long time, meaning they're going to take on more debt, meaning they're going to take on more losses that have to be funded with debt.
Yep.
So there's a long runway, and can they take off, or will the plane pop a tire
or does something else come? Does some other company come along, or like Constellation Energy Group or GE Vernova? Whatever, there's a lot of other companies potentially in that space as well.
Or you could just buy a boring natural gas pipeline company that is already making money and is supplying the natural gas to power these data centers.
Yeah.
But that's too easy.
Yeah, exactly. Well, it's going to be this is going to be one of the interesting things that's going to come up is that we talk about, and I posted a tweet about this morning. I said two things about these data centers, because if you look at the ramp of power usage that these data centers are going to require, it's exponential over the course of the next 5 to 10 years. So be ready for higher electricity costs at your home.
Well, it's already happening.
Yeah. It's going to get worse. And the question is at some point, when do those powers that be start to figure out that pay their fair share is going to have a very different meaning in the future, right? We went through this whole thing where the rich need to pay their fair share of taxes. The question I think is going to ultimately become is when are these data centers going to pay their fair share of the electricity costs?
Right. And I think that's coming sooner rather than later, possibly with the next set of elections.
Yeah.
Because I would imagine that some people are going to run on that. It's like, why are we paying for the data centers? So Amazon and Meta and all these other companies can make these enormous profits so that these billionaires can become multi-billionaires.
Yeah.
I mean, it's all part of this kind of populist movement that's been going on for a long time now. And it will probably just
no, and look, and I'm just wondering if Meta turns into the next Enron now that they're getting into power trading. So I'm not saying that, but I'm just saying. Last time we had a company speculating in power trading, turned out not so well. Anyway, I got an email yesterday from one of our listeners that asked a couple of questions, actually 3 questions here, and the first question was what do you think about the impact to the market if the court decides against tariffs? This is that the Supreme Court should decide on tariffs by the end of this year, whether or not. And so the question before the court is simply this: did President Trump have constitutional authority to impose a tax on foreign countries? That's the only question. Was it constitutional or not? So if they rule against that, which I think there's more than a decent probability that could be the case, saying, no, you didn't really have the authority to do that, that's then going to kick all these tariffs back to Congress. Congress is going to have to pass a bill to keep these tariffs in place. If they don't have the majority to pass the bill, then there's some potential other outcomes. We may have to refund tariffs. There's a lot of other potential consequences. So the only question between now and the end of the year is, did he or did he not have the authority to use executive powers to issue a tax? Because taxes are a function of Congress. They are the ones that control the purse. They're the ones that have to, if there's going to be an increase in tax, it has to be passed through Congress and Senate, signed into law, those type of things. So that's the big question. So do you think the markets react positively or negatively?
I mean, it's a good question. I think what makes that a little harder is that Trump will work around it. And he has said there are many ways that if it fails, I think Trump's setting up for a Supreme Court to rule against him. So what will he immediately come out with that basically reinstates him in another form? And because of that, I'm not sure the market reaction will be that big. In theory, it should be positive for stocks and bonds because tariffs were negative. So you should have the opposite, although the stock market's been up a lot.
I was going to say, despite the concerns about tariffs are going to cause this massive wave of inflation and all this that never occurred.
Well, here's what happened, right? We're going to put 50% tariff on China. Trump would come out and say that. The market drops 2-3% in a day. 2 days later, he comes out and says, just kidding, 20%. The market rallies. So I think the market has kind of shown you that it prefers no tariffs to tariffs, right?
Right. Or at least lower tariffs.
And we know the bond market has this concern that tariffs are inflationary. So, I think on the margin it should help. But again, I think it really matters. What's Trump going to do if he loses? How will he work around it? Will Congress work with him? There's starting, to be a little division within the Republican Party. Is that enough that he couldn't get bills so easily through? Yeah. And what do the deals even look like? Because most of these deals aren't signed agreements yet. They're just, paying in advance of what they think it'll be. So, it's kind of like Hassett. There's a lot we don't know, and there's still a lot of time to digest it all.
Well, and kind of going back to Fed rate cuts, the other question that was in this email was asking about, what would be the impact on the dollar? So if the Fed cuts rates, is that good or is that positive or negative for the dollar? And there's still a lot of this idea out there that the dollar's being debased and that the dollar's going down in value and those type of things. Yet the dollar's been, and you've heard less of that lately because the dollar's been rallying again, which is not surprising. But if you start getting Fed rate cuts, historically, is that better for the dollar, or what do you think?
It's the dollar in relation to every other country. Most countries have been, not counting Japan, have been cutting more than us. So we start catching up, which is kind of funny. The dollar has been getting debased, quote unquote, right? The dollar's been falling. It's down, 10, 15% this year. And we've been more hawkish. Our Fed has been more hawkish than the European central banks and most other central banks, China too. So, I think it's a tough decision, like everything else. I'm not sure which way Fed cuts will really cut. I think it comes back to that original argument we had about Hassett, is growth or inflation. And I think if inflation can start coming down, a lot of the fears, which will help the dollar, will go away.
Yeah. Well, and two things that'll happen also too if the Fed cuts rates is that should help support the markets. That should also help kind of the economy on the margin. So a stronger economy, stronger stock market, that's going to drag more foreign assets into the U.S. dollar. So it should actually wind up making the dollar stronger. And again, this is kind of an interesting comment. Back to our comments. There was all this concern this year that nobody wants U.S. stocks, nobody wants U.S. bonds, nobody wants to be in the dollar, et cetera. And there was actually a really, really good chart yesterday. This is the 2025 flows globally into stocks, bonds, and credit. And by far and away, so again, if I buy U.S. stock, if I'm a foreign investor and I buy U.S. stocks, I'm investing in the dollar. So everybody invested in the U.S. stock market this year. Bonds, by far and away. You've got almost $500 billion worth of bond flow this year into U.S. Treasuries versus kind of the rest of the credit market. So again, these are the problems with these narratives, is that just because something's declining in value doesn't necessarily mean it's the end of something. It's we have stocks go down in value doesn't mean that every company's going bankrupt now. It's just after a big rally, they're going to have a correction, and you're going to get a rally again.
Well, let's talk about the bond narrative we were talking about a year ago.
Yeah.
Last time I was here.
Yeah.
A year ago, the bonds were about, 50, 75 basis points higher in yield.
Yeah.
Because the deficit was a huge problem because inflation was raging. Well, inflation has kind of stuck around the same level it was back then, right? Mm-hmm. The deficit hasn't gotten any better, and it's probably gotten a little worse than people thought it would be. Yields are 50 basis points lower. It's because that narrative has faded. Mm-hmm. It was never a great narrative to begin with, but it's gone.
Right.
And it's the same with the debasement trade. That narrative that the dollar's going away and we're going to be using euros or Bitcoin or gold or whatever it may be, it's already fading. You don't hear it nearly as much as we did a month or two ago. Yep. And that'll be gone. There'll be new narratives that take its place.
Yeah. Well, and again, that's just kind of always the case with this, is that, we've talked a lot about it on the show before, is that when something's happening, right? Gold's going up, gold's going down. Stocks going up, stocks going down. Just a good example of this, right? So the stock market has a 5% correction, peak to trough in November.
Right.
Whole narrative is the AI trade is dead, right? It's all over with. There's nothing's going to work. These companies are taking on debt to fund build out. Yeah, of course they're going to take on debt to fund build out, right? Why would I spend my cash to do that when I can go borrow debt, get a tax deduction for the interest, and then use somebody else's capital to go build out these data centers? Why wouldn't I do that? But again, the narrative was like, oh, this is all going to lead to a big blow up. It's all 1999 again. And there's a lot of differences between now and 1999. I'm not saying that there's not potential for an AI bubble. I'm not saying that at all. There's certainly some similarities to what we've seen in previous bubbles. But everything can't be 1999 or 2008 or whatever it was, right?
No, and I think it's interesting that narrative, though, is changing. Mm-hmm. It's shifting a lot. So it was, if you go back kind of post the April tariff day, Liberation Day, it was these companies can do no wrong, right? AI is going to control everything. They're going to get all the revenues. Everything's going to be great.
And so, by the way, so far that's been the case.
Right. Every company that has the word AI in their name or says they're thinking about doing something with AI goes up, right? And then we started thinking about, well, what about all the debt? And what if AI doesn't produce the revenue? And you can see how this narrative kind of shifts and bends and turns. And now it's kind of, I feel like there's a little bit of picking the winners and losers. Mm-hmm. Is it going to be Google or OpenAI? Who's related to OpenAI? Oracle's on the bad end of that trade right now. Google is doing well, and then it's like the Google TPU chips versus the NVIDIA GPU chips, and and those differences.
Yeah, and that's right. But that's kind of my point about narratives, and whether it was dollar debasement or inflation, we get these narratives that run around, and what we do is we try to, when something's running up in price, Bitcoin's going up in price, it's because nobody wants to be in the dollar, everybody wants to be in Bitcoin, and then Bitcoin collapses 20%.
Right.
And then that narrative goes away. And this is our whole point that Mike and I have talked so much about in the past, is be real careful with narratives, because narratives are just a rationalization of what's happening in the markets right now. It's very rarely tied to what actually is occurring.
No, and I think where we spend a lot of time is trying to understand a narrative. Is a narrative
valid,
valid, or is it not? Right? The dollar debasement, how many articles did we write on that?
There's a lot.
And a lot of it, and it's not just that we wrote them in the last 6 months when dollar debasement was the big headline. We've written them in years past too, because some of it is to educate, to let you know what we think about dollar debasement, but some of it is just to remind ourselves of, is there really dollar debasement? Are we looking at this the wrong way? And it's helpful to just dig in, read both sides of the narrative, make sure you're looking at kind of everyone's view, not just one side of it, and assess for yourself. And look, a narrative can still be a great trading tool. If you know what's driving the market, jump on the narrative, just understand if it's true or not true, because if it's false, you just have to think about what changes to take you out of that trade.
Yeah.
So,
and again, when the narrative shifts, then that's when you need to be out of the trade.
And unfortunately, narratives can shift very quickly.
Well, they seem to shift a lot more rapidly now than they did, earlier in our careers. A narrative would last 3, 4, 5 years.
Here's a great example.
Now it lasts 3 or 4, 5 days.
I think it was late January.
Yeah.
DeepSeek came out, right? And DeepSeek was going to get rid of NVIDIA.
Right.
It was all going to be
OpenAI was done.
OpenAI was done, right? And it had its impact for a day or two, but no one really priced that in. That was not a narrative that it always had to be OpenAI and NVIDIA. And then those two companies really, OpenAI is private, but NVIDIA did well, and so did many of the other AI companies. Now they're starting to question it again, right. but it's longer lasting. It's not just this one hit to the market.
Right.
So, I think the strength of the narrative was strong back last January because the impact was a day or two, if at that. I don't even think it was 3 days.
Yeah.
Now it's starting to weigh on certain stocks. And, it's just a very interesting market now with these narratives coming in and out of vogue daily.
And also, too, it's important to remember that we've had a huge run this year. From the April lows of this year, we were down 20% peak to trough. Mm-hmm. It's been a very, very strong run into year end. And so what I find fascinating is like, in May, June, July, August, September, as you said earlier, nobody could do anything wrong. You just threw money at the market, it went up. Super easy to invest. And now you're getting a little bit of, as I was showing this morning and before the bell, we're getting a consolidation in the markets. We're just trading sideways. We're about where we were a month or so ago. And all of a sudden there's all these, oh my gosh, this is going on and that's going on and it's this narrative and that's part of this is just that we're consolidating some massive gains. Again, we have to rationalize why the markets are just chopping around here. We just have to do that because we're human beings. We have to assign a reason for something. But sometimes the reason is just as simple as that we're just consolidating a massive run this year. It was a 30-35% gain from the lows.
Yeah. But I think also you have to keep in mind, though, that the S&P was only down 5, but there are some stocks down 30, 40, 50.
Absolutely.
Some of these quantum computing stocks.
Yeah.
Oracle.
More.
And, a bunch of stocks that are well down. So it's when you're looking at these broad indexes, I think they mask it a little bit as well.
Absolutely.
And there are stocks that have done very well. Right, like Lilly's one of them, and
AbbVie and
Google,
others, yeah.
Right,
Google.
So the market's kind of doing this, but you got a lot of up and down within the index.
Well, again, this has been also kind of one of the problems with the index. We've talked about market breadth, and the breadth of the market's not great. There's if you're not invested in the right handful of stocks, you're probably not making a lot of money this year. Right. There's a very big difference between what the index is doing, and this is. Every year we get the annual reports out, right? It's like last year, 80% of fund managers underperformed the index. Well, if you owned anything other than just basically a handful of stocks, you probably underperformed this year.
Yeah. I mean, how many times do we look at those relative scores and they all have negative relative score?
Exactly.
That means they're their technicals are not as strong as the S&P 500. It's
Yeah.
kind of crazy.
And that makes it a challenge, but that also forces more and more investors into the same handful of stocks. So they buy the same ETFs, which drives those stocks higher.
Right.
It's a self-fulfilling kind of prophecy for the markets. Question is what breaks it? I have no idea.
Well, and that's the problem. It puts all the eggs in one basket,
Yeah.
right? If NVIDIA were to come out with some bad news, you could break the whole market.
Sure.
And that's the risk.
And that's going to happen at some point. It is inevitable that eventually NVIDIA is going to come out and say, we missed estimates, we missed earnings, we missed revenue projections, because the revenue projections just keep ratcheting up and up and up and up. Eventually, just the law of statistics, it says they're going to miss.
We overbuilt. We spent too much on CapEx.
Something.
But they'll tell us beforehand, right?
Yeah. I've got a direct line with Jason, so we're like
Good.
this.
Yeah.
We're
So
like
don't.
this,
So you guys don't have to worry about it. But the rest of the world,
we'll let you know. Yeah. Jason will call me first, and then let me know. So
Okay,
anyway,
good.
or
Got
Jensen.
you covered.
I said Jensen. Yeah. So it shows how close we are. I call him Jason because we're close. We're like this, right? Anyway, all right, that wraps up the show for the day. Thank goodness. We'll be back tomorrow, of course, with Richard Rosso and for Financial Fitness Friday. Back next week for another week as we get through Mutual Fund Distribution Week. That'll be a lot to talk about as well. A lot of economic reports. There's a Fed meeting next week. Michael Lebowitz back here on Thursday. We'll cover all of that. So in the meantime, have a great day. Be sure and like and subscribe to the channel. Helps us a lot. Also, make sure you get by the website, realinvestmentadvice.com, and click on the link to get your tickets to the upcoming Economic Summit, January the 17th at the Royal Sonesta Hotel here in Houston. Lots of great speakers talking about crypto, AI, financial planning, investments, bonds. You name it, we're going to cover it. It's all going to be there with Adam Taggart as well. That's coming up January 17th. Get your tickets now before they get sold out. See you then.